Good morning and welcome to the Peters MacGregor Global Equity Update. My name is Alex Haynes, Head of Distribution. With me today is Wayne Peters, Chief Investment Officer, and Nathan Bell, Head of Research. Wayne and Nathan will provide you an update on the Peters MacGregor Global Fund, our key holdings within the portfolio, and our outlook on global markets. The webinar will run for approximately 30 minutes, and we will then have a Q&A session at the end. With that, I'd like to hand over to Nathan.
Thanks very much, Alex. So first of all, I'd just like to show the disclaimer, which we'll assume to be read. If anyone ever wants a copy of that, by all means, please let us know. So before we get into, or before I introduce Wayne and we talk about a couple of stocks in the portfolio, I just want to go through the way we invest, just so that it will give some context to the sort of stocks that we look for, and some context to the stocks that Wayne and I are going to talk about. So as you can see there, we've got the three rings, which aren't as complex or as exciting as the 5 rings from the Olympics, but for us, they're absolutely far more important. So the 3 rings are: we're looking for a great company run by great management, and most importantly, we need a great price. Now, just about any analyst worth their salt can probably tell you what are the best businesses right now and who are the better managers out there. But what distinguishes us is the willingness and to have the patience to wait for the right price, because it doesn't matter how good a quality business you own or you buy, if you pay over the odds, then you're never going to make a decent investment return. So you can see there's a few things we look for in terms of great business. It's good economics. We're really looking for businesses that have high returns on invested capital, because what that does, or what that signals, is the sort of business that earns a lot of money for the amount of money it invests in the business, and generally it shows it's got some sort of competitive advantage that the competitors struggle against. So if we find that a business has high returns on capital over a long period, then usually that's a good sign that this business has something special or enduring about it. And what we really want to own is business, or when we want to own businesses for 10 years or more, as we do, we want those businesses not only to be able to defend their market positions, but grow them over time. And that's what's going to allow them to compound their earnings at high rates. So in terms of our portfolio, we're a concentrated fund manager. We generally only have 15 to 30 holdings. It's generally closer to 20. We're not sitting here trying to have idea of the week or idea of the month. What we really want is just very high quality ideas that we're highly confident in, that we can put decent amounts of capital to work in. So as you can imagine, the market is mostly efficient most of the time. So what we're really trying to do is just pick up when the market's got things wrong, so that we can buy those great businesses cheaply. We don't have any formal limits around industries, but obviously when you run a concentrated portfolio, we still want to have the sort of diversification that we don't want to wake up tomorrow and find 80% of our portfolio invested in one industry that's going sour. But we don't have any formal limits there. And again, around our value philosophy is, we do a lot of hard work trying to understand our businesses and what we think they're worth. But then once we own those businesses, it's not a case that, we'd love to own them for 10 or 15 or 20 years, because it makes our life much easier. But if it's a case of either something has changed in our investment case, or maybe the share price has gone up and it's gone up to our target value, then we'll sell those businesses and look to replace them with new, more attractive opportunities. And then cash is really just a byproduct of that process. So when we're finding lots of ideas, we'll be more fully invested. And when we're struggling to find those great companies with great management at a great price, then we'll have more elevated levels of cash. This is just a very simple slide that shows you that in our universe of stocks that have all those, the great business qualities we look for, and they generally tend to be stocks or businesses with over $1 billion market value. There's about 4,700 in our universe around the world. But when you're actually looking for the types of things that we are, it actually gets rid of a lot of those stocks very quickly. So we use filters and screens until we know the list down. But I'd say the most important thing for us is that we're reading widely on a daily basis, and that's generally where we find our best ideas. So I always use the analogy that we're like firemen, and when we see a fire, we run towards it, because that's potentially where you're going to find an undervalued business. So the next slide is just an update of our performance, and we don't sit here looking at our own performance over 6 months or 1 year or 2 years. We are genuinely long-term investors, and what matters to us is our performance over the long term. So you can see since inception we're 2% ahead of the index, and over 7 and 10 years we're up around 3% ahead of the index. So that just shows you that, I mean, it doesn't look like much on the surface, but when you actually run those numbers out over a long period of time, it's actually amazing how much further in front of the index you can come out. And I think our recent performance has been okay. And as I show on the next slide, we're value investors, so if you look at where we are in the cycle, this shows you our 5-year rolling returns. And as value investors in a very expensive market, you can see that in 2011, for example, we were well out in front, and that's, if you remember, was back in when everyone thought Europe was going to collapse. And that's when we were really in there buying good quality business at a cheap price, and you can see our returns were very good over that period. And then as the bull market has marched on, and a lot of businesses have been carried by momentum rather than their value, which dominate the indexes and have really driven the performance of the overall index, our returns have come back to the average. But if you look through a full cycle, then whenever that turn in the cycle comes, we certainly expect to have that advantage back out in front again. Our portfolio, where this shows the regional exposure by revenue of the underlying business divisions within the stocks that we own. So it's not where the companies are listed, but rather just where the company actually earns its revenue. So we're quite diversified there. You can see half is in North America, and we've got about 8% in the United Kingdom, and the Australasia is the Michael Hill position. We don't generally invest in Australia. We try to keep things global, but over history we've had 2 or 3 ideas over time. And you can see the cash there is about 20% at the moment, but that number will just move around depending on the sorts of opportunities we're finding. So the next slide is our top 10 holdings. This isn't really going to change too much from quarter to quarter, so you can expect to see a lot of the same names over time. One of the main themes, there's probably 2 main themes in this list. There's firstly, we own 4 banks. We own a couple in the UK and a couple in the US. That's Wells Fargo and Bank of America in the US, and Lloyds and Royal Bank of Scotland in the UK. The case for those banks, and I guess particularly the UK banks, is the recapitalisation. There's still government ownerships within RBS and Lloyds. Lloyds only has about 12% government ownership at the moment, and RBS, I'd say, is about roughly 3 years behind in its recovery or recapitalisation than what Lloyds is. So Lloyds at the moment is suffering from having to take large provisions for insurance that it sold pre-GFC, or I should say that it missold. And so as those fees or those fines and provisions go away over the next couple of years, then we expect the underlying earnings of this business and the cash flows and the dividends to increase markedly. Royal Bank of Scotland is very much in the same ilk, but as I said, it's about 3 years behind, so I'll be waiting a bit longer for that company to start paying higher dividends. The other theme in there is 2 stocks we're in: Precision Castparts and Rolls-Royce. Rolls-Royce is a jet engine manufacturer. It's under previous management had made some very poor investments in diesel engines, which were in use particularly in the oil and gas industry, which is not going well. But we believe over the next 5 to 10 years that the sales of the new, more fuel-efficient jet engines is going to produce a very profitable and long-tailed repairs and maintenance contracts, which is really where Rolls-Royce makes its money. And Precision Castparts, as some of you may know, is currently under a takeover offer from Berkshire Hathaway. And Precision, again, was a company that made mission-critical components for jet engines, amongst other things. And it's a business we really liked, but unfortunately that's going to be taken off us. But again, if you listen to a lot of people, there's a theme out there about Asian travel. We really do believe in that theme, but Rolls-Royce is the way we want to play it. We think there's a very good business there. We like the recurring revenues from the jet engine maintenance stream, and we've got a new chief executive in place too, so we're expecting more information from him next week in terms of what he's learned about the business in his first few months at the helm and what the strategy is for the business going forward. So I'll introduce Wayne now. One of the companies that we've fairly recently added to the portfolio is one of John Malone's companies. John Malone, you may know, he's famous for being the cable guy in the US and other parts of the world. He's made a fortune bringing cable into millions of homes, and one of the offshoots of his business is a company called Liberty Media.
Thanks, Nathan, and thank you everyone for joining us this morning. Yeah, the portfolio is as attractive today as we've seen in a long time. We're certainly struggling to find new names, but Liberty Media is a more recent acquisition to the portfolio. And as Nathan mentioned, we spend a lot of our time where we're seeing fires, where there's a lot of bad news in the marketplace. Our general view, and I think this has been borne out over the 15 years that we've operated, is that whenever there's an industry or business that has a generally rosy consensus around the marketplace, the prices are generally very, very high, and finding value is very difficult in those circumstances. So we want to find companies and industries that are under pressure, under bad news at the time of us finding those investments. And then, of course, the skill is in determining whether that bad news is, a fatal flaw to the business, or whether it's just a flesh wound. Now, Liberty Media is a very interesting business. It has a number of assets, but its main asset is the 58% holding in another listed company called SiriusXM. This is a satellite radio operator, and it is now it holds a monopoly in that space. It was an oligopoly prior to Sirius and XM merging. I'm not quite sure why the regulators allowed that merger to happen, but it happened post GFC, so I guess they weren't overly concerned with the monopoly power that would accrete to the company after the merger. But we are certainly seeing the value of that position now in the pricing and the growth in the subscriber numbers. The business, though, was under a cloud because of the concern of the rising internet music providers, such as Spotify, Apple Music, and the like. Our view, though, is that this company's main competition has been and will continue to remain for a long period of time the free-to-air advertised stations, where you listen to the stations and you're hearing the advertisements on an ongoing basis. SiriusXM currently offers 165 channels, all advertising free, and it also has first-rate content, shows like Howard Stern. They have the live broadcast rights to the National Football League. These are all highly valued content and in high demand for people in their cars. So these assets, we believe, will allow them to continue to compete and grow their footprint as cars that become enabled with this technology continues to expand. So the addressable market is easily 3 times the size of its current saturation, and that overall market is trending to grow very significantly as new cars come onto the market or are equipped with this satellite reception equipment. One of the hidden gems that we believe we see in this business is the additional broadband coverage, which will allow them to go to 650 channels as opposed to the current 165, and they will be able to compete there with a different model to a subscriber model, and that is a free-to-air but an advertising-based model similar to their current competition. So we believe management's very rational. They've clearly been very skilled in their execution, and we expect the business to continue to grow. And so the ownership we've selected to get access to Sirius is not through the core listing, but through Liberty Media, which is controlled by John Malone. Sirius is undergoing significant stock buybacks at the moment, as is Liberty, and Liberty are not selling into the SiriusXM buyback. So their percentage is currently 58%, but we expect that to continue to grow. And at some stage, we would expect Sirius to become a fully owned subsidiary of Liberty Media. So that's a very exciting prospect in the current portfolio, and it's performed extremely well since we added it just on 2 months ago. I might now move these slides that we're just running through, just give a bit of an overview, but we'll move to another holding in the portfolio, which we added in about June of last year. and that's the Fiat Chrysler Automobile Corporation. At the time of our purchase, the company was under a lot of pressure. It was still had its main listing in Milan, in Italy, and our view was the market generally had the sense that this business was still an Italian auto manufacturer, and who would want to own an Italian auto manufacturer? But the management, led by Sergio Marchionne, who in our view is the most highly rated CEO within this very, very competitive industry, had done an outstanding job in the 10 years that he'd been CEO. Basically, Fiat was a almost bankrupt Italian auto manufacturer when he came to the CEO's role back in 2004. And in the 10 years, he transformed that business into an international car organisation, which ranked 7th as far as production numbers. And his 5-year plan, which to many analysts seemed to be outlandish, we felt, given his track record of under-promising and over-delivering, that he had a fairly high probability of executing. We are now 2.5 years into that 5-year plan, and he is well ahead of executing on that 5-year plan. So our confidence has only built since we purchased the position in June of last year. The most recent activity has been the spin-off of one of their major brands, and that is Ferrari. So this business has numerous very highly regarded and highly sought-after brands, Ferrari being one of them, Maserati, and of course in the SUV space, Jeep. So Ferrari was spun off just on 3 weeks ago and equates to almost 65% of our total investment in this business back in June of last year. So needless to say, the stock has performed extremely well since we've purchased it, but the potential moving forward is still as attractive as the day we bought it. The shares of Ferrari will be handed to the shareholders in Fiat come January for the 80% that Fiat owns in Ferrari. So if we are still a shareholder and haven't been priced out of this position by then, we will be shareholders in the Ferrari listed vehicle, which has the ticker RACE, R-A-C-E, and also Fiat, which is FCAU.
Any other comments on FCA?
Well, I mean, for anyone who's interested, one of our early readings on the industry, because this had been an industry that had really gone through a transformation post-GFC, and there's a book called Overhaul, which was a great summary of how this industry has transformed itself, and it continues to do so. I mean, Marchionne has been very proactive in seeking a merger with General Motors, and of course his early suggestions have been rebuked, but I just wouldn't underestimate that negotiating skill, because the logic behind his argument for a merger with GM is almost undeniable. If you take the personalities aside and the short-term incentives, then I would rate the probability of this merger at greater than a 50% chance. So, you know, again, the industry is a very, very tough industry. Long-term, the current structure is not likely to remain, but with Sergio heading up our investment, we're very, very comfortable with the position.
And Wayne, a question we get asked a lot is, how do you reconcile the great business aspect that we're looking at with the pretty ordinary economics of the auto industry?
That's a very good question, Nathan. I mean, some businesses, of course, you know, we feel like we can just lock away and forget about for 10 or longer years. But the confidence that we have in the management of this business and the strength of the individual brands, and Ferrari's been a very good example of that. I mean, it's listed at a price that, and it recognises the economics of that particular business, and just unlike any other auto industry. If you look solely at the financials, you wouldn't think it was an auto business. Maserati has very similar dynamics, and Jeep is off the charts with its performance simply because of the strength of the brand. And so with these valued brands within the organisation and a master capital allocation and operator in the guise of Sergio Marchionne, we feel that those qualities really tick the boxes for us as far as the investment opportunity.
One of the bones of contention with this company is that, in particular, in regards to Ferrari and Maserati, these premium brands where they like to keep the supply low to keep demand high. The company has said that they're going to increase the number of cars they're going to sell for both Ferrari and Maserati. How do you think that plays to that premium brand?
Well, let me just put that in perspective, Nathan. I mean, Ferrari's production last year was just on 7,000, which is nothing in the auto industry. So it's a very, very low supply product. The plan that Sergio has in place is to ramp that up to 10,000 within the next 5 years, and that increase in production is going to be in the emerging markets, especially China, where their volumes are very, very low at the moment. So their fundamental motto has been to sell one less car than is demanded for. They don't plan to increase their production or sales through the developed markets, so we don't see the forward plan as threatening the value of the brand and the scarcity factor, which clearly plays enormously to the value of that brand.
Okay, so there's a couple of case studies of companies that have reasonably sized positions in our portfolio. We've also got some time for some questions, and one of the ones that we've received already is, how do you see values on global markets in a relative sense currently? For example, is the US expensive at present, and is this making you hold more cash than you otherwise would?
Well, clearly we've had a bull market for the last 5 years. We are certainly finding it more difficult to find the high quality businesses that we seek at an attractive price. But our portfolio is ever only going to be 15 to 30 positions, and we just do not allow the overall market valuation or any macro views or concerns to reflect on us taking a position. If we find a business for some esoteric reason, and in many instances it's company specific and has nothing to do with the overall market valuations, then we will take the position. Cash, as you mentioned, Nathan, is simply a byproduct of us finding opportunities. We can move to 30% at any given time in cash, and we're currently sitting on just on 25% cash, but that could be back to 0 or 10% if we were able to find 3 or 4 more ideas that qualified our criteria. And our watch list is very prospective at the moment, and my experience has been these opportunities can spring up totally unexpected, and we just needed to have done the work and be prepared when those opportunities arise, and can be totally unrelated to the overall marketplace.
I think there's also a view that Europe's a bit cheaper than the US, so why don't we have a lot more exposure to Europe? But it's actually been for quite a while now. If you actually look at those high quality businesses in Europe, which are less plentiful anyway than what they are in the US, the valuations for those sorts of companies are anywhere from 20, 25 up to 30 times earnings. So it's not a case of just thinking that, okay, the Europe's a little bit cheaper than the US, we should have more money there. It's about those individual opportunities that you're looking for. And when you have the high standards that we set for the companies in our portfolio, it's not just a case of open slather. We're really quite picky about those businesses. So if a new company is going to, if we're fully invested in, theoretically, if a new company is going to take the place of an existing position, it really needs to be, a bet that we're highly confident in. We think it's going to really look after us for the next 10 years. And as I said, those sorts of businesses in Europe in particular are just as expensive in Europe as they are in Australia. In the US.
Yes, I would agree with that. We've just had another question come in from one of the participants. With such good returns from Liberty and Fiat, why have returns been marginal over the last 12 months? Well, the trailing 12-month performance to September was 23.3%. So I'm not sure how that could be viewed as marginal. It was 6% over the index, and in many ways we had, one hand tied behind our back because we averaged about 24% cash through that period too. So the risk to the portfolio was significantly lower than the market. Plus we obtained an outperformance of 6.5%. So we're very pleased with that result.
And it's probably worth mentioning that the cash we hold at the moment is in US dollars as well. So even though we've held high levels of cash, there's been quite a decent return on our money just for having that money in US dollars. But obviously we don't want to count on that over the long term because currency tends to wash us out, and we're just focused on trying to find individual businesses for the portfolio.
We've got another question come in here. What action is or could be taken in a GFC scenario to protect the portfolio? The number one risk mitigant we have in the portfolio is the analysis and depth of understanding we have of the businesses that we're invested in. The idea that we or anyone can time being in and out of the market due to macro concerns, we think is a fool's errand, and it's very, very difficult. So we simply undertake to find businesses and seek out to hold in the portfolio that we believe will compete extremely well, irrespective of the economic tides. Our observation historically has been that these competitively entrenched businesses tend to grow their intrinsic value through downturns, although it's not recognised in the marketplace at any given at that time. It's only when the rebound occurs that you see the increased value that they've created through the downturn. And this comes by a number of factors, not the least being the diminished competitive landscape that they're up against. The weaker competitors tend to fall by the wayside, and the strong competitors tend to grow their market footprint and their competitive position during these downturns. So we spend no time trying to time the market. We're simply looking to hold a basket of outstanding businesses that are priced attractively that we believe will compete well, irrespective of what the competitive landscape or the economic landscape does.
One of the interesting aspects from that question, which we get quite a lot too, is there's always this fear that we're going to have another GFC. The next downturn may only be 10 or 20%, and because there's low rates around the world, maybe we'll be sort of situation a bit more like Japan, where the pain is just spread out over a much longer period. Now, not necessarily forecasting that, but the problem is that you think because something's happened recently that that's the way things are going to pan out next time, and it might turn out that the GFC, which is one of those once in a generation or longer opportunities or periods or whatever you want to call it. So to sit there and think that every downturn is going to be like the last one runs the risk that you hold too much cash over a long period of time when you could be making good investments in businesses that are coming under pressure for company or industry specific reasons.
I mean that's a very good point, Nathan. Clearly there's been macro provocations over the last 5 years to which if you'd listened to, you would have been sitting on the sideline and missed the biggest bull market in the last 10 years. We just don't know how to do that. We're looking to just find productive businesses that we know on average will earn an above market return on the invested capital, and during the downturns, certainly if we're sitting on cash, that will give us more opportunity to deploy that money moving forward. One further question that's come through, if you have 25% in cash, wouldn't the 25% depreciation in the currency have contributed about 6% in performance, suggesting a relative weak performance in the invested portfolio? Yeah, the strength of the US dollar relative to the AUD has certainly helped the performance in AUD over the last 12 months, but 6 of that 23% position still gives a gross return of around 15 or 16%, which in any given year we think is an absolutely superb absolute performance. I mean, our expectation for the average return of the performance lies somewhere between 7 and 10%, based on our discount rate of 10% that we use and the discount to our intrinsic value that we use as our investment requirement before we make an investment in a position.
And the currency impact is also included in the index, and if you have a look at a lot of other performances from fund managers recently, it's been pretty awful out there. So I think on the face of it, the actual results are pretty good. We're pretty happy with it.
Okay, well, thanks Wayne and Nathan. for your comments, and I'd like to thank everyone for joining us today. If you're not registered already, I'd encourage you to sign up for our News and Insights service via our website. There are also multiple ways you can access the Peters MacGregor strategy, either via our pooled trust or our managed account service. And we also just recently launched a separately managed account service with an administrator called Mason Stevens, if that's of interest. If you have any further questions or feedback, please refer to the slide in front of you. And again, I'd like to thank you for your time today.